So I have really two outcomes that I see happening that span over a long period of time, and how I think that would affect our portfolio and how we design the options. And this is, I did just tweak one thing, Oscar, from last time that I saw probably incorrect. And we're looking really far into the future, so of course this all has to be taken with a grain of salt. So let's say the China deal doesn't implode and escalate into the election, which I think is not likely just based on the last 2 years, but maybe that happens. And let's say the impeachment is not actually pulled to a vote in the House. They just use it to create more hysteria. So sure, maybe that both of those major risks don't become a problem. The repo madness, I think the Fed can bandage with some liquidity. So, in a perfect ideal world where nothing goes wrong, what's our potential outcome? So we have lowering rates, or even just keeping them at this low rate. We have a low inflation, although we know there's not really low inflation, but if they're going to go with that narrative that there's low inflation, and then we have, and we can also talk about what happens if they lie about low inflation and don't do the correct monetary policy. And that's really why you have the chance of Elizabeth Warren taking the president in a year, is because of this, just that. And we'll go back to that in a minute. But if we have low rates, or even lowering interest rates, low inflation, at least by their report, and quantitative easing, you get an all-out bubble. So this is where we're long everything under the sun. We're just grabbing the highest quality products that have the least risk, because we know we're in the middle of a bubble. So that's our current setup with SPY, emerging markets, TLT, and GDX. So what happens? Eventually, we get rising inflation. So we're already seeing employment, wages rise, unemployment levels are going lower, everything's looking good, but all of a sudden, the increase in cost to produce goods starts to create inflation pressure. And this could be going on with QE, which is this kind of what's in stock right now if nothing goes wrong. But eventually we get rising inflation. So the Fed's told us we're not going to raise rates until inflation is stubbornly above 2%. Actually, their word is symmetrically above 2%. And Fed even said that they're trying to work on some new plan that will be released mid next year to force inflation. So I don't know what that is. I don't think anyone does. Hasn't been really discussed much in all the commentary, but I think it's something along the lines of social security net, some sort of system designed to get money to flow from the bottom up instead of the top down. So one way or another, they're going to get their inflation. That would be negative for the bond market, because it'll eventually force the Fed to raise interest rates. So in this perfect environment where nothing goes wrong and everything stays calm, eventually inflation should cause the Fed to raise interest rates, and we melt down this bond bubble we're in. And the size of it's just massive, $266 trillion, $16 trillion in negative yielding. So you got to realize somebody has to sell that bond at some point, or else they're going to lose money for decades at negative rates. So those have to go away one way or another. And so they're in this predicament, the central banks, of how do we support the financial system and get rid of these bonds that are that have to be sold. They're at negative rates. No one can hold those. There's no reason to. So at this point, we'd be using the inverted option collar on the TLT, and most likely have an outrageous stock market that's gone much higher than anybody thought possible. Until we get such a high yield on the bonds that it's become so attractive that money floods out of the bond market into the stock market. So this reminds me of 2018. We had stocks rallying all year until the 10-year hit something like 3% yield, and that was just way too attractive. Also during the period where the Fed was raising interest rates. So if we get rising inflation, we're going to slowly start increasing the rates. The Fed's going to tell you everything's great, economy's wonderful, and then the bonds get too attractive, and you get the flow from stocks into bonds. And so this is the period where I think we get our last hurrah in gold and silver. During this period, we'll try to take our profits on that. Stock markets will be going down, and bond yields will be bouncing lower, and bond prices going up. Then we get to the point where there's no quantitative easing, and the Fed is aggressively rising rates for too long to offset inflation. And this is where you get your double meltdown. This is similar to that period we've studied in 1965 through 1980, where Paul Volcker kept having to raise rates and then drop them back down. Inflation came right back, and he raised them higher, back and forth, back and forth. And eventually, they were able to get all the malinvestment out of the economy and have a great period. So in this period, we're short stocks, short bonds. And so if we think about Elizabeth Warren coming in, people are upset. You know, they're telling us there's no inflation, but there clearly is inflation. Our cost of living is significantly higher. Our wages are flat. That's why someone like her could come in, and she would just take QE to a huge new level. And perhaps what she would be able to do is, wait, let me get back to my slide. I think what she would successfully do is pop the bubble much faster. She would create inflation at rapid pace, and this would be our setup for an Elizabeth Warren scenario. Maybe there's a short period of time where you can make some money in gold, but soon as the inflation is flooding in, pretty quickly we have to go to this setup, and that is the setup that very few investors will be prepared for, to be short bonds and short stocks at the same time. Most of the whole financial system revolves around a setup just like what we're using currently, where the system isn't broken yet. And so the second that snaps, because the central bank can't do QE and they're raising interest rates, the clear strategy will be to just have some money in the bank to collect your income, and then to be short these assets for the capital gains on those assets, betting down. And then we get the reset. You can look at that whole period with Alan Greenspan being able to drop rates from extremely high rates and gradually lower and lower. And so in that scenario, which is probably quite as soon as we've popped both bubbles and have had enough time to recover from that, that's when we be able to switch into a much more aggressive scenario. We replace the SPY with the QQQ, and we replace the TLT with LQD, and then most likely it'll be Apple to replace the cash, which would be Buffett's top pick. So that's one outcome, where the bond market crashes first due to inflation, and stocks go tremendously higher. And for our advisory, obviously, we compete with people who are just sitting in their 401k or their IRA, who've bought and held stocks and done very well over the last 2 decades. And they're not even necessarily scared of a 30-50% crash if they think it may just pop right back up. But if you listen to good old Ray Dalio and you look at the 50-year cycle, he thinks we're actually going towards a 50-year cycle. Could that happen? Sure. The whole rosy scenario. What might happen if China decides to press the button and really put pressure on Trump, and this impeachment goes to the Senate? They actually vote in the House maybe by December. Now I'm hearing maybe they'll drag it into February. And now it goes to the Senate. How many people are potentially bought out in the Senate or unhappy with Trump? So those are two big pressure points I see coming that are at least dead obvious that we can all see right in front of us. I'm sure there's plenty of other black swans out there. In this scenario, my expectation is we still have low rates, low inflation. QE, that'll be ramped up. But in this scenario, a lot of volatility. We're going to want to be primarily betting down on the SPY and emerging markets, not for necessarily extremely long periods of time, but on any catalyst, you can expect some serious sell-offs. We've seen that already in the last year. Now, the crash in October through December perhaps was a lot different than some of the crashes we've seen recently from tariff threats, but that has been going on for the past 2 years. And so I think these are going to start to get more and more intense. In this scenario, we do the inverted collar on the SPY and emerging markets, and we're long bonds and gold. Eventually, you get back to rising inflation. The second that starts to pick up, but prior to the Fed actually announcing they're going to have to start raising rates during this period, back to long the stock market, as I would expect a flood of money to escape the bonds and then jump into stocks at a discount. This period, we can still be long our precious metals, but during this period, we're going to need to get out and try to call a top in all this, because what happens next is we're back to rising rates and no quantitative easing. And that's really the nightmare disaster. Is once there's too much inflation, the Fed gets stuck. They can't save the day anymore. They only have 1.5 to 1.75 federal funds rate. So they really have limited ammo to save the day with lowering interest rates, unless they headed into negative territories. So at some point, we will have a period where they have to raise interest rates and stop doing QE. So once again, you get back to that nightmare scenario that pretty much no financial system can handle, which is where stocks and bonds sell off together. And then we get back to the reset. So slightly different. One outcome, the bond market pops first, and that would be where everything goes hunky-dory and money all of a sudden escapes the bond market because they realize inflation's coming. The central banks can't lower rates anymore. They're already at the bottom. In the other scenario, we can expedite this whole process by popping the stock market first with some trade tensions. And so, and maybe the impeachment, but I think the China pressure would be a bigger ordeal. And they may be connected, hard to say on that. So that's kind of the two outcomes I see happening, and how we don't have to change our underlying assets too much, but just to switch the direction, and then we'll be optimizing those Friday hedges, depending on which scenario seems most likely.
How are you going to be able to determine QE when the Fed isn't even calling accommodation QE anymore?
So here's where we watch their balance sheet. Let me find
Oh, okay.
So yeah, they're not even calling it this, but they're certainly doing it. So at least they do. Here's the look at that balance sheet. There you go. But they're not going to do it. They're not going to stop. The sheer amount of debt, just the interest on the debt, is unbearable.
Right.
So they really need to devalue the currency to make the debt more manageable. And so as long as the government is creating deficits and those deficits are growing, It's almost an, there's no other option. It's either the government's not funded and the bond market collapses, or they lower interest rates and print money. So we can go look at Europe zone, Japan, to kind of see where we're headed. So what could save the day? What could stop the Fed from lowering interest rates? And we can actually look at what the administration's team is saying they're trying to do about the deficit. Every once in a blue moon, they'll talk about the deficit. But their goal is to get the GDP steadily over 3%. And with GDP over 3%, we can start to balance the budget out. So the catch is, to get these high GDP numbers, they're creating even larger amounts of debt. So it's just a big joke. We want to get the GDP growth without all the debt. And until we see that fix itself, where the GDP is growing and the growth of debt is either flat or slowing down, the pressure is going to be for either yields to skyrocket, which would force all the money in the bond market to think twice about where what yield they've agreed to, or sell for a loss before it gets worse. So that's one option, or, which would be essentially just blowing up your own financial system. Or they can artificially create this belief in the market that you can hang on to these bonds because the Fed has to lower interest rates and buy up these bonds at a better price. And so this has gotten to such an extreme that there's $6 trillion in negative yielding bonds. So it's complete chaos, and they're trapped. So they really don't have a choice here but to lower interest rates. So that's why I continue to put us in that TLT position with such a loose collar, because it's just, there's no way around this. Now, again, if we get a phase one trade deal, will there probably be some downward pressure on the TLT? Certainly. We've already seen that reprice itself very quickly when that surprise announcement came out. But the big picture is not resolved. And until the government's deficit is reduced and the GDP can really show strength without creating additional debt, it's like imagine you're a company and you go take out a $10,000 loan and then go buy $5,000 worth of products from yourself and say you have a $5,000 profit. It makes no sense. So we're taking on more debt than we're creating in growth, and the scenario is getting worse and worse by the year, because our interest payments alone are $500 billion a year, and in the next decade, it's at a target to hit $2 trillion a year of interest. So the whole system is motivated to push these rates slowly but surely lower. So that'll be bullish for our bonds. Now, the only thing that could really make me think bond prices aren't traveling higher would be to see everything possible go right. So we'd need to see the global growth slow down, change course. We need to see China back to printing growth. Their GDP has crashed from something like 14% 5 years ago to 6%. So that thing is falling like a rock. So the pressures are very clear. Also, if I go to our live stream content, JP Morgan, it's sometimes we want to pay attention to what they're doing and not necessarily what they're saying. But they're making a huge move into long duration bonds right now. And I think it's because they know the Federal Reserve is going to be lowering rates, which is going to make these bond prices go up. And at some point, they're going to replace the overnight repo lending mechanism with a one-time big bailout. And so if they can buy these bonds today and then flip them to the Fed in 6 months for a huge profit, I think that's what they're aiming to do with this move. And then also 23 interest cuts are projected for central banks in Q4. So that's going to put a lot of pressure on the bond market towards lower yields and higher bond prices. So I really like our setup right now. We can slowly make some easy wins on the SPY, and sure, the TLT has given us a little bit of a drawdown, but the TLT has been reacting in big jumps to the upside, so it's been hard to catch the gains in the TLT if you're being overly defensive. So that's kind of our big picture right now. Quite a time to be. Here's those bank reserves causing the overnight lending problems. And so you can see they've lost about $500 million of liquidity in the last 2 years. And Goldman and JP Morgan have been throwing out numbers about needing around $300 to $500 billion to fix the money market problem. But also, why is this cash balance going so low so quickly? So maybe 500 billion would fix it for a year, but would it fix it for the long run? Probably not. And what's causing this, shortfall of $180 million a night that's being lent out? And it's not clear, but some of the news coming in that the SoftBank is a $100 billion fund. I did misquote their loss on the live video. It's about $6 billion they lost in this quarter. But I think it's companies like this, the private markets, who have been, evaluating all these tech companies as billion-dollar companies, even though they're losing money. So they just lost $5 billion, mostly on Uber and WeWork, and who knows what else they've been losing money on. So I suspect a lot of the losses are from investments like this, but who knows? Nobody knows exactly who's short. These $180 billion is what's being lent overnight right now. Some of that's in a 14-day repo, and then some of it's in overnight repo. But yeah, the big players are all making moves that would indicate that there's trouble ahead, despite the stock market being at all-time highs. We got Berkshire at a record cash pile. We've got all the central banks cutting rates. Everything's not just hunky-dory.
Love your pictures.
It's this hedge cartoon guy. He is great. He's always he's on top of the story every day. I really love it. Yeah, they're funny. Well, that's pretty much what I have for you guys today. Here's the daily dump videos that'll come out. So we had some good interviews yesterday. Ray Dalio was out. Well, let's see what he's just put out a new LinkedIn piece. So Saturday, I'm going to try to give you guys a reading list. Monday through Friday, it'll just be YouTube videos. So during the week, you can just have some pretty effortless videos to watch. And then on the weekends, I'll give you a handful of articles. I haven't read it yet, but he's been putting out a lot of LinkedIn pieces that are very long and definitely a great guy to listen to. His interview was basically very similar to what we were summarizing, is that we have this huge wealth inequality, and that's creating a lot of upset people, and that there needs to be some major changes in the way capitalism works. So he's talking about social nets. We've seen JP Morgan almost parrot the same speech. They've been doing this for well over a year. And perhaps it's the billionaires just trying to fix the system before someone like Elizabeth Warren comes in and fixes it for them. Perhaps not to the best strategy, but yeah, he's just saying, look, the bond market's trapped. It cannot raise interest rates, so it has to just sit here and print money, and eventually that'll create inflation. So I guess that's kind of the summary on that one. JP Morgan's interview was interesting. He gets railed about WeWork for a little bit, but also talks about the repo market. They ask him what he thinks about the Fed, and he thinks they're smart and doing the right things, but they should give him permanent fix, not the overnight fix. The money GPS video, this guy's a character. He's always super bearish. I guess that's how he's made a name for himself, but he does spend some time going through a lot of the details of who are the primary banks, how does this whole repo operation work, what's been the timeline of all of it, you know, what have they been telling us versus what's happening in terms of timeline. This Sven Carlin is not someone I normally listen to, but he had a great 10-minute video, really looks at how risky the markets are, and also spend some time questioning the Fed's actions, and then a little Fox Business piece about the tariffs and how China's now wanting them to roll back tariffs, which could be huge. If that really happened, we'd probably want to have some more valuable puts protecting the TLT without shortchanging ourselves by selling a call option that's too close to the trading price. So now that we know, you know, at the earliest this is probably happening sometime in December, I think we'll be relatively stingy and tight on our option callers on the SPY leading up to that period of time, and continue to take on a lot of risk in the TLT just in case things get hairy between now and that meeting. Now, right before that potential meeting, and as we get closer to it, I'll probably risk a little bit more on the put option to protect our TLT, and perhaps not sell such a close strike on the SPY, so that if there is some good news, you know, we can capture a profit on a big bounce in equities. And I may even buy us a little downside protection on our gold position as we get close to this. Now, I still think bonds and the bond market's trapped and will travel higher, but just to reduce a little volatility in our account and to hedge against that risk that, hey, what if they really do create some kind of trade deal, roll back tariffs, peg their currency? That could be very, very bullish while we have all these central banks printing money and lowering rates. So yeah, that's pretty much what I see happening and how we're going to play it. Any questions?
Nope, pretty much. Jason, thank you for the knowledge.
Hey, my pleasure. It's always great to have you guys live. And we got our freebie webinar, so if you guys want to join that, great. If not, I don't intend to have anything new outside of what we covered today. So you probably, I don't expect anything new on it like we had last week. But yeah, always a pleasure. Really appreciate everybody. And we'll have our next VIX trade Friday, unless the stocks crash by then.
No. I love picking your brain. Thank you.
Hey, Tom, I see your chat message. I appreciate it. Thank you guys so much. Until next time.
Yep, thank you.
Let me throw up our disclaimer so I don't get sued here. All right. There
No, yeah, do that.
Can't follow instructions or something. All right. Thank you, guys. Have a great day. We'll talk to you tomorrow.
Take care.